Good morning, Charity.
Good morning, Claire.
Oh, I just wanted to confirm that you can hear me as we wait for participants to log
Yes,
in.
and I realized that my microphone had been muted and it is the video instead which was running. Yeah.
Yeah. Okay.
Okay. Mm.
Okay. So let's give them a few minutes.
Okay, let's wait for them to log in.
They log in.
Okay. Yeah, will I share my screen as we go along, or you will be the one controlling from your side?
No, you're going to share from your end.
Okay, okay.
Mm.
Okay, that's fine. Cutting. Does
Good morning, ladies and gentlemen. I'm CPA Esther Kaliwa-Chisache, the coordinator of this program. Today, in the morning, we are having CPA 17, advanced taxation. Then later, during the mid-morning, we shall be having CPA 9, that is auditing, ethics and assurance. And in the afternoon, we were supposed to have CPA 12, advanced financial reporting, and it was rescheduled and it will take place on the 3rd of April, Wednesday, 3rd April at 2 p.m. So kindly inform your friends who had registered for that webinar. Our session chair for today is CPA Claire Najiko, who will take you through the program of the day, and then she'll be the moderator of this session. Claire, you're welcome.
Yes, thank you, Esther, for that, CPA Esther, for that kind introduction. This morning, my task is very simple. It's just to guide this student engagement, CPA paper 17, advanced taxation. And before we start, I'm going to give a brief profile about our presenter. So this morning, we are blessed to have CPA Akatukwasa Charity Wizera to take us through the requirements or the needs or the things that we need to have in order to pass paper 17. CPA Charity is a member of ICPAU, so therefore it means she went through this same process. She sat this same paper and she passed. So she qualified as a member of ICPAU, and she's also a member of the Institute of Certified Public Accountants of Kenya. She holds a postgraduate diploma in tax and revenue administration, that is PODITRA. CPA Charity is also a graduate teacher by training from Makerere University, where she graduated in 1990. She worked as a secondary school teacher for 7 years. From there, she worked with the URA, the Uganda Revenue Authority, for 7 years as a revenue officer, as well as a trainer for the PODITRA course. She thereafter worked in the private sector as a tax consultant at PwC, that is PricewaterhouseCoopers, for 9 years, where she retired as a manager in June 2016. Charity is currently self-employed as a tax agent approved by the URA in her private business called Value Impact Management and Finance Consultants. So therefore, Charity is the best person to speak to us on how to pass advanced taxation. Members, join me to welcome CPA Charity. But before she comes in, I'd like to remind you that if you have questions, concerns, kindly post them in the Q&A, and we shall attend to them after a presentation. So Charity, you're most welcome, but you'll do the presentation for roughly 1 hour, and thereafter we shall have the questions for 30 minutes. Thank you very much. Charity, you're most welcome.
Thank you, Claire, for the introduction. I'm going to share my screen. I hope you can all see the screen.
No, I can't see it yet.
How come? Screen. Can you see it now?
No, I'm not seeing it. Don't know what is happening. Get out. But
I'm trying to share, but I don't know why it is not sharing. Can you see it now?
yes, I can see it.
Okay.
Mm.
You can see the first page right now.
Yes, I see it.
Okay, so we can proceed from here. Thanks, Claire, for the handsome or beautiful introduction. Let's go into the presentation. So advanced taxation is at level 3 of the accountancy qualification examination. And all level 3 examinations test professional skills where they are intended to assess the ability of the student to apply, synthesize, and evaluate technical knowledge, professional skills, and values, strategy, and leadership in real-world situations. So as candidates for paper 17s are doing their revision, they should have in mind what the general skills that are needed to be tested at this level. You realize that when the syllabus was revised recently, advanced taxation was moved from level 2 to level 3 in the revised syllabus that was first tested in May 2023. Therefore, the learning outcomes were also enhanced to reflect the level. And the examination structure also changed. For those of us who may be sitting the paper several times, you may realize that the previous structure had a different allocation of marks. And as we shall note ahead, we shall see how the examination structure changed. The content of the subject, however, remained the same, but there is expected emphasis on professional skills given that the paper was moved from one level to the next level. The overall aim of the paper is to equip the learner with skills to manage and advise on tax matters in all sectors of the economy, and to contribute to tax policy formulation and implementation in Uganda. And this is reflected in the learning outcomes of the paper. So what are the learning outcomes? When you look through the CPA syllabus, there is a hierarchy of learning outcomes. The learning outcomes coming from the simplest to the most complex learning outcomes that are expected. The papers which are in the first level will mainly test knowledge. And this is mainly recalling of facts and ideas previously learned. This is the basic learning outcome when somebody has just started the paper. Then the next level is comprehension. And in comprehension, it's mainly demonstrating an understanding of facts and ideas by organizing, comparing, translating, interpreting, giving descriptions, and stating the main ideas. The next level of the learning outcomes is, can you now apply the knowledge acquired? The application level refers to the usage of knowledge and skills to solve problems. The acquired knowledge, facts, techniques, and rules are applied in various ways to create new situations. The next level is analysis. And in analysis, candidates are required to examine and break information into parts by identifying motives or causes, make inferences, and find evidence to support generalizations. The next level of the learning outcomes is to compile information together in a different way by combining elements in a new pattern or proposing alternative solutions. And then the highest level of learning outcome is the evaluation process. And this is the ability to judge the value of the material at hand for a given purpose. So throughout the accountancy profession, there are various learning outcomes that are expected from all the 18 papers that an accountant is expected to attempt. So what are the learning outcomes of paper 17? The learning outcomes of paper 17, one of them is to determine tax liabilities for an individual, a partnership, or a corporate body. You realize that on this particular learning outcomes, candidates are expected to build up on information that was learned, the knowledge that was obtained while you were doing paper 11, which is on level 2. The level of assessment for this paper on these learning outcomes will mainly be application. So the questions will not ask you to simply state the knowledge that you have learned. The questions will be aiming at application of this paper. Then the next learning outcome is to provide tax planning advice. And the level of assessment for this particular one is evaluation. And as we have noted in our learning outcomes, evaluation is the highest level of learning outcome, where the candidate is expected to give judgment. Hello? Be quite a bit. I can hear some noise in the background. Okay, provide tax planning advice, evaluation, which is the highest level of learning outcome. So the candidate is expected to provide advice and give judgment, evaluate different options, give the best option out of the options available and such things. Then the other learning outcome is to demonstrate an understanding of domestic tax laws. And the level of assessment will mainly be comprehension. Do you know what the domestic laws are talking about? And can you explain them or use them to solve the problem at hand? That is what the level of assessment, that's what it means. A candidate is expected to have an understanding of the domestic tax laws. The other learning outcome is to demonstrate an understanding of customs management and international trade. And this one also, the level of assessment is comprehension. Can you understand what the law means and use the laws to solve the problem at hand? The other outcome is to demonstrate an understanding of tax issues relating to international transactions. And then advise on best practice and ethical ways of handling tax matters. This is at the highest level of evaluation. And also advise on emerging issues in taxation. This is the last tax paper that is done by an accountant before they qualify, and therefore they are expected to provide all sorts of advice to their clients once they have gone through the course. The examination will test the learner's comprehension and ability to apply, analyze, and evaluate Uganda's tax system and provide tax planning advice, as well as adopt best practices when dealing with clients. However, this examination assumes that the candidate has basic tax knowledge, which is tested in paper 11, taxation, which paper was also moved from level 1 to level 2 in the new syllabus that was first tested in May of 2023. So what are the learning outcomes of paper 11? Because you need to know them before you can go to the advanced taxation. The outcomes include to explain the objectives of taxation and factors that determine the country's taxable capacity, the forms of taxation in Uganda, the evolution of tax administration in Uganda, then to compute tax liability for an individual and corporate entity, to advise on application of the tax system to an individual and corporate entity in Uganda, to prepare tax returns and other correspondences for individuals and corporate entities, to demonstrate an understanding of tax assessments, and to discuss ethical challenges encountered when handling taxation issues. You will realize that most of the learning outcomes in paper 11 are on comprehension and application levels. Whereas in paper 17, students are expected to analyze, synthesize, and evaluate. So whereas the topics in paper 11 and paper 17, when one is having just an overview of the syllabus, seem to be the same. The level of responding to the learning outcomes is different. So the person doing paper 17 is expected to have a deeper understanding of the taxation issues at hand than the person who is handling paper 11. So what is the summary of the syllabus right now? The syllabus, first of all, includes Uganda income tax. And under income tax, candidates are expected to cover the taxation of business income for corporate bodies, individuals, and partners in a partnership. As you all know, a partnership is not a tax-paying entity, but it is an accounting entity. It has to first account for how much profit has been made, which profit is distributed to individuals who constitute the partners in the partnership. Then taxation of employment income. It's kind of unique. It is also business income of the individual, but it is kind of unique in a way that the employer is expected to account for this tax. But it is similar to the business income of an individual in terms of the tax rates that are used. Under income tax, we also find how do we handle any capital gains. Uganda as a country does not have a capital gains regime, but any capital gains earned by a company or an individual are taxed under the income tax. Then we have property income, and under property income, that's where you find various regimes of withholding tax, because most of the property income is taxed from source. We have the taxation of petroleum operations. And then we have international taxation, which includes the anti-avoidance rules. And under the anti-avoidance rules, that's where we find transfer pricing and everything that goes under transfer pricing. So you realize that income tax is really a very big section of the syllabus. And as expected, a very big proportion of the examination will tend to come from income tax because it is a big proportion of the syllabus. Then we have other tax heads that are taxed: the value added tax, excise duty, customs management and procedures. We have tax administration, and the tax administration will usually tax matters that are contained in the Tax Procedure Code Act. We have tax planning, current developments in tax, and then ethical issues in taxation. So in summary, this is what the syllabus covers, but each of the subtopics that we have seen has so many other items that come under it. As you are arriving at the taxable position or the chargeable incomes, there are several rules that are followed and they are included under each of them. This is just the summary of the syllabus, and I believe all of you have access to the syllabus and you can pinpoint out whatever is supposed to be covered. So what is the examination structure? The paper is a 3-hour examination, which is made up of two sections, Section A and Section B. Section A comprises one compulsory question of 50 marks, and Section B comprises 3 questions of 25 marks each, of which the candidate is required to attempt any 2 questions. There is no limit to where the questions can come from. Section A can have a question coming from any topic. Section B can have questions coming from any of the topics in the syllabus, because examiners will examine about 80% of the syllabus in any question, in any examination that is set. Therefore, a candidate cannot afford to ignore any part of the syllabus, because we do not know where questions will come from. They can come from any part of the syllabus. We shall now go through some of the problem areas that make students not pass the paper in accordance with the last 3 examiners' reports. And we shall start with the most recent, that is the December 2023 examinations. These are only a guide as picked from the mind of the examiners, but there could be other reasons why candidates think that the papers, they may not pass the papers. And at the end of my presentation, if there is anyone who thinks there are some reasons why maybe the papers are not passed and I have not touched on them, they can be brought out in the question and answer session, and then they can be communicated to the examiners to take, maybe to see what can be done. So in the December 2023, question 1 was on corporate income tax of a resident manufacturing company. Like we have seen, the major aim of the paper is to equip an accountant to handle taxation matters of different sectors in the economy. So the examiners will pick questions from any sector of the economy, and most sectors may have issues that are unique to them. So you as a candidate, you are supposed to be an all-rounder and you know the specific issues that are unique to each sector. So this time the question texted corporation income tax of a resident manufacturing company, and it required the candidates to advise the management of the company on the chargeable income and tax payable for the year ended 30th June 2023. It also required candidates to examine on advise on the capital allowances claimable against the income for the year ended 30th June 2023, advise on the due date of filing, including any penalties due, if any, to provide guidance to the accountant of the company on the procedure of handling an assessment where the taxpayer is not satisfied. It also required the candidates to explain the concept of a permanent establishment and advise the management of the company on whether the company will be liable to tax in Uganda. So what were the observations picked from the comments of the examiners? the majority of the candidates were able to identify the expenses not allowed for taxes, as well as the incomes that do not constitute taxable income. This was in the process of determining the chargeable income, because there are several adjustments that candidates are required to do in order to arrive at the chargeable income. And in this particular examination, the majority of candidates were able to identify the adjustments that are required in order to arrive at the chargeable income. The majority of the candidates appreciated the categorization of assets, additions into 3 classes, as per the tax amendments commencing on 1st July 2021. However, some candidates still computed the wear and tear schedule using 4 classes, as was before the amendment. And this could mainly be attributed to candidates using old reading materials to prepare for the examinations, not considering the fact that Uganda's tax laws have been changed every year in the recent past 10 years. So candidates need to be conversant with the changes that take place when the budgeting cycle is done every year. Still in question 1, many candidates were not conversant with the treatment of disposal of business assets in the case where a passenger motor vehicle initially costing more than 60 million shillings was sold. Many candidates did not apportion the disposal proceeds between the depreciable and the business asset in the wear and tear schedule, which greatly impacted on the capital depreciation allowance. Again, this question required the candidates to test for interest deductibility using 30% of earnings before interest, taxes, depreciation, and amortization, as provided for in Section 25 of the Income Tax Act. The biggest percentage of the candidates did not consider this, where a company is part of a group. The interests are deducted needs to be tested to see whether all the interest should be deducted or not. Then some candidates gave the 15th day of every month as the filing date for the final return of the company. Yet, income tax returns are filed they are filed within 6 months after the end of the year. But some candidates gave the 15th day of every month, as happens for those taxes whose tax period is a month, like pay as you earn, VAT, withholding tax. Those ones, the filing period is a month, and they are filed by the 15th day of every month. But even for income tax, some candidates still gave the 15th day of every month as the filing date. Part B of the question required candidates to give the objection process. This is under the tax administration of the syllabus, where we said those questions will mainly be coming from the Tax Procedure Code Act. This part of the question was well attempted. Though some candidates could not give the process in a chronological order and could not clearly tell the role of each player in the process. And whereas the objection process is now provided for in the Tax Procedures Code Act, many candidates were still making reference to the Income Tax Act. So the objection process was repealed from the Income Tax Act and is instead in the Tax Procedures Code Act. So candidates should take note and read all those acts in order to acquaint themselves with the tax laws. Part C tested the candidates' understanding of a permanent establishment or branch and its taxation. I think most of the candidates may not have been acquainted with the term permanent establishment as is contained in international tax laws to be the same as branch in the Uganda domestic tax law. And as a result, this was the worst done part of the question because of the term used and inability of candidates to relate the international tax term with the domestic law equivalent. This paper tests international taxation and domestic laws. So candidates are supposed to acquaint themselves with terms in international tax that may be used in the domestic laws as well. The way candidates responded gave an indication that they may not have understood what a branch is and how branches are taxed in Uganda. And this calls for students to read and understand more about the basics and application of international tax, considering the increasing number of cross-border transactions and digital economy. It is also important to note that income tax being a historical tax, this is because a year of income can only be taxed when the year has ended. It means that amendments for the year commencing 1st July 2023 can only be tested after the year has ended. That is 30th June 2024. Exams attempted between 30th June 2024 will therefore be based on the tax laws applicable for the year 1st July 2022 to 30th June 2023. Question 2, what was it about? The question was on taxation of business income, dividends, and rental income earned by an individual, and requesting for candidates to advise on the tax payable for the year ended 30th June, to explain the meaning of dividend according to the provisions of the Income Tax Act, while elucidating in detail the tax implications on dividend income of an individual taxpayer. The majority of the candidates were able to determine chargeable income. However, most imposed a flat tax rate of 30% for non-individuals, as opposed to the individual rates of tax, despite the individual rate being provided in the question paper. Many appreciated the concept of computing rental tax separately. However, they applied a different rate of tax. They applied a rate which was not applicable for the year. It It is important to note that the rental tax rates have changed 3 times since 2020, and candidates should be keen on the year of income in the question and apply the correct rate. More than 90% of the candidates who attempted the question could not define dividends, making reference to the income tax and how they are taxed when received by individual taxpayers. Question 3 was on VAT, and it tested candidates on the classification of supplies for VAT purposes and the computation of VAT payable, treatment of offsets brought forward, and withholding VAT credit. It also required candidates to explain the circumstances under which a taxpayer may be deregistered from VAT, including the procedure for deregistration. Majority of the candidates were able to compute tax using both the rate and the fraction. What do I mean here? When you are given amounts and the examiner mentions that the amounts are VAT inclusive, that's where we say we use the VAT fraction. And where they are VAT exclusive, we apply the rate of 18% directly. So most of the candidates were able to pick out where to use the rate and where to use the fraction. However, some candidates were not able to classify correctly the supplies dealt in, and others decided not to classify where VAT was not computed. And this makes it hard to ascertain whether the item is exempt or zero rated. There is a difference between exempt and zero rate. Zero rate, the amount is taxable, but at a zero. Exempt, VAT is not applicable. So when candidates put dash against an item, it's difficult for the examiners to pick out whether the item is zero rated or whether it is exempt or whether it is outside the scope. Those must be pointed out so that the examiner can know that the person knows the schedules and knows items which are zero rated and items which are exempt. The question had exempt supplies, which means that the input tax allowed was supposed to be apportioned. But many students did not apportion the input tax, and they posted all the input claimable, which would lead to under declaration of the tax payable. Majority of the candidates were unable to adjust for the credit note in relation to the damaged sugar that had to be returned. Part B of the question was not well attempted, as many candidates were not well grounded with the circumstances under which a person can get off the VAT register, and they could not tell the obligations of a taxpayer, the procedure during the registration process. Question 4 was on customs, and it tested the computation of the CIF value, which is the cost, insurance, and freight value, the resultant taxes payable on importation of ladies' clothing, penalties relating to prohibited and unaccustomed goods, as well as the understanding of the authorized economic operator status. This question was least attempted and was the worst performed question as well. Most of the candidates who attempted this question had knowledge of what is included in the CIF value for customs purposes. However, they could not compute all the applicable taxes at importation. Many only computed import duty, VAT, and withholding tax, and left out the infrastructure levy. Other candidates computed excise duty, which was not implicated from the question, therefore arriving at the wrong VAT on the import, wrong VAT on import computation. In most cases, when the examiner gives, from past experience, when the examiner gives a question on customs, the applicable rates are given in the question. So where an excise duty rate has not been given, then the examiner may not be expecting candidates to compute excise duty. Candidates exhibited very little knowledge in regard to offenses and penalties relating to prohibited and unaccustomed goods. And the majority of the candidates who attempted this question had no idea about the authorized economic operator, neither could they tell how it works and the advantages associated with it. But generally, the December paper was well performed by candidates. August 2023, question 1 tested corporate income tax of a financial institution, and it required candidates to advise the bank on capital allowances and the corporate income tax liability for the year ended 31st December 2022, and the likely tax consequences of the marketing and advertising transaction to the bank on the basis of the provisions of the Income Tax Act. To also advise on opportunities available to the bank and the group that can be utilized to plan their tax, minimize excessive or unnecessary income tax payments in Uganda, and to explain to management of the bank the likely consequences of aggressive tax planning to the company. How did the candidates respond? The candidates fairly exhibited appreciation of what qualifies to be an allowable and non-allowable deduction in line with the Income Tax Act. However, there were instances where candidates did not know how to compute tax payable by starting from the amount of profit before tax in the income statements, while some simply rewrote the income statement. This is a clear indication of not preparing well enough for the examination. Candidates are advised to revise the recommended format for presenting the tax computation that is contained in the ISPAO recommended reading materials. The majority of the candidates appreciated the categorization of assets additions into 3 classes as per the tax amendments commencing 1st July 2021. Candidates also recognized the fact that the taxable benefit accruing to a qualifying item was to be restricted to initial allowance in the year of acquisition and the charge for wear and tear deferred deferred to the following year. However, most of the candidates missed a major description of the assets in the question, which stated that 3 branches, Mbale, Arua, and Masindi, were commissioned during the year, and the following equipment installed provided in each of the branches. This failure of the candidates to recognize that the list provided was to be multiplied by the 3 branches affected the classification of assets, and therefore wrong calculation for initial allowance and the amount of qualifying assets deferred to the next year. This particular sitting, failure to recognize that in the question made many candidates fail question 1 and affecting their overall performance. So candidates are encouraged to read the detail in the questions in order to be able to properly interpret the requirement. Also, majority of the candidates did not accord the loss brought forward its correct treatment as an allowable deduction before arriving at the chargeable income. Some candidates were even deducting it after determining the tax payable, yet loss brought forward is not a tax credit. Many candidates did not consider the credit for provisional tax paid during the year, while many candidates used the estimated chargeable income as the tax credit. Some candidates also treated the tax credit brought forward as a deductible expense, which is not correct. Part B of the question. Okay, part A2 of the question required candidates to advise on the likely tax consequence of the proposed marketing and advertising transaction. The proposal was to centralize the marketing and advertising function to head office, which would lead to an increase of this expenditure by 20%. Candidates did not appreciate how the tax authorities are likely to respond to such related party transactions. Majority of candidates exhibited lack of knowledge of transfer pricing provisions and anti-avoidance requirements as per Section 90 of the Income Tax Act. And the majority of the candidates in Part 3 were unable to advise on any planning opportunities available to a group of financial institutions. The few candidates who were able to enumerate some opportunities did not relate them to the sector. Planning opportunities can be found both in the domestic income tax laws as well as international laws, such as the double taxation agreements and other international tax norms. In Part B, candidates were not able to advise on the negative side of tax planning, which is aggressive tax planning, where the revenue authorities would likely interpret the schemes as tax evasion, as opposed to tax avoidance and the consequences to the company. Question 2 in August was on employment income, where the employee has rental income on the side as well. And candidates were required to advise a resident individual on his total chargeable income and tax payable for the year, and to explain to the individual the obligations of an employer with regard to taxation of employment income. Candidates were also required to distinguish between taxation of an employee as opposed to an independent consultant to enable the individual make a decision on whether to go independent or not. The question was fairly well done, with majority of candidates being able to identify that the income of a resident person is from all his geographic sources. Candidates were able to accord proper tax treatment to the allowances and benefits earned by the individual, both in Uganda and while on duty abroad. However, some candidates were not able to compute correctly the loan benefit, affecting their computation of chargeable income. For clarity, interest on a loan acquired by the employee during the year for purposes of calculating the loan benefit is time apportioned. Majority of the candidates were able to identify that rental tax is computed separately from other income tax. However, the rate of tax to be used was the one as per the tax amendments for the year commencing 1st July 2021 to 30th June 2022. And this required an individual to be granted expenses at 75% and the residual chargeable income taxed at 30%. But majority of candidates used the rates either prior to 1st July or after 1st July 2022. So it is important to note the year of income that one is referring to. In part B1 of the question, most of the candidates were able to advise on the obligations of the employer, but majority could not advise on the differences between an employee and an independent consultant, and therefore we are not able to advise the individual on the better choice between the two. Question 3 tested VAT and excise tax. It required candidates to advise the company on the local excise and the VAT payable or claimable for the month of February 2023, advise the accountant of the company on the circumstances where a taxpayer may issue a manual receipt under FRIS, the likely consequences of omitting invoices from FRIS to the company. Majority of the candidates were able to compute the input VAT using the VAT fraction. However, there are candidates who could not interpret correctly VAT inclusive and exclusive amounts. And many candidates interpreted the zero-rated international transport as exempt. A few candidates did not translate the amounts designated in foreign currency to Uganda shillings, therefore distorting the amounts in their computations. And it is important to note that taxes in Uganda are payable in Uganda shillings. So whenever you are given amounts in a different currency, they need to be translated to the Uganda shilling. Majority of the candidates did not compute excise tax on the ex-factory amounts provided, and therefore we are not able to compute the correct VAT exclusive amounts for the computation of output VAT. It should be noted that consideration in relation to a supply of goods or services means the total amount in money or kind paid or payable for the supply by any person, directly or indirectly, including any duties, levies, fees, and charges paid, or payable on or by reason of the supply other than tax. And in the VAT law, whenever they mention tax, they mean the VAT, reduced by any discounts or rebates allowed and accounted for at the time of supply. Therefore, excise tax is part of the consideration. Majority of candidates did not treat the distribution of returnable containers as transactions outside the scope of excise tax and VAT. Part B of the question required the candidates to have knowledge on EFRIS, especially when a person registered for VAT could issue an invoice outside EFRIS, and the penalties for not complying with EFRIS requirements. EFRIS is a very hot topic these days because the URA is implementing penalties, vigorously implementing penalties. So it is likely to be a hot topic for the examiner for the foreseeable future. So candidates should take interest in EFRIS and all that surrounds it. Majority of candidates were not aware of the provisions of Section 73B of the Tax Procedures Code relating to penal tax relating to EFRIS. Question 4 tested capital gains on the sale of business assets for an individual person intending to become non-resident, and required the candidates to advise the person on his tax compliance status before he applies for the tax clearance from URA, clearly pointing out the capital gains or losses that may arise from the transactions and the tax treatment for each of the listed transactions. And to explain to the individual the circumstances under which a taxpayer is treated as having disposed of an asset. Most of the candidates who attempted this question had an understanding of how to compute their adjusted cost base. Under Section 51(5), a resident person who becomes a non-resident person is deemed to have disposed of all assets other than taxable assets owned by the person at the time of becoming non-resident for their market value at that time. However, candidates used sale proceeds instead of market value for purposes of calculating the capital gains. And according to Section 53 of the Income Tax Act, consideration received on disposal of an asset includes the market value at the date of the disposal. And this was important because of the circumstances of the sale. The amounts were likely to be understated and not representative of the market values. None of the candidates that attempted this question was able to compute the capital gain and balancing charge on the sale of the road vehicle. Passenger motor vehicles is deemed to comprise of two assets: the taxable or depreciable asset, which is 60 million, and the business asset that is comprised of the balance. When such a motor vehicle is sold, the proceeds are apportioned between the two assets to determine the capital gain or loss on the business assets and the balancing charge or deduction on the depreciable asset, if all the assets in the class are sold. Majority of the candidates computed capital gain at a round figure of 30%, instead of aggregating all the individual's income and computing his tax for the period using the resident individual tax rates. And majority of the candidates were able to explain some circumstances under which a taxpayer is treated as having disposed of an asset. When we go to May 2023, this was the first examination diet in the revised syllabus. And question 1 tested corporation tax of a farming enterprise, which required candidates to compute the company's capital allowances, chargeable income, and tax payable for the year ended 31st March 2023, to advise the management as a tax consultant on the tax treatment of the listed transactions. The listed transactions were one where the company buys calves and yearlings and feeds them for 2 years, after which they are sold for beef to a slaughterhouse, and how the accountant was treating it. The accountant deducts the cost of purchase of the animals in the year they are bought. Then the company had bought land which had a coffee plantation. The cost of land and the growing crop is separable, and the company wants to claim the cost of the coffee crop as a deduction during the year. The other scenario was that the company has working animals on the farm, the horses, oxen, that are used to pull the carts of harvested crop as well as digging. The animals are not sold but are used on the farm to do various work activities. The company, however, incurs costs in purchasing them and maintaining their health. Then in Part C, candidates were required to outline specific income tax incentives given to persons engaged in farming activities in Uganda. In this case, some candidates presented the wear and tear schedule using 4 classes, contrary to the requirement of the question and the amendments commencing 1st July 2021. The changes under Section 27A are to the effect that assets are classified under 3 classes, and the taxable benefit accruing to a qualifying item has been restricted to initial allowance in the year of acquisition, and the charge for wear and tear deferred for commencement in the following year. And majority of candidates were not conversant with capital allowances available for agriculture as covered in Section 35, farming, whereas majority appreciated the concept of minor capital expenditures. Only very few attempted to identify what amounts to farm works, and no candidate managed to give the farm works the correct treatment. Candidates are encouraged to interest themselves with the relevant sections of the law, including those that are relevant to particular sectors of the economy. Then majority of the candidates failed to give provisional tax its correct treatment as they were treating it as an allowable deduction as opposed to subtracting it from the computed tax. Provisional tax paid during the year is not an allowable deduction. I think I had mentioned this one under another observation. Most candidates were not aware that expenses are only admissible for tax purposes in the periods where revenue or income attributable to that expense is declared as stipulated in Section 22 of the Income Tax Act. Advice for treatment of the cost of calves bought and sold after 2 years and the purchase price of the coffee farm. Majority of candidates indicated that the expenses should be allowed for tax purposes in the year that they were incurred, despite having no corresponding revenue. And majority of the candidates do not have a deeper understanding of what qualifies to be plant and machinery. Many classified horses and oxen that are used to pull carts of harvested crop as well as digging as biological assets, and very few would classify them as depreciable assets. Working animals on the farm are classified as depreciable plant and machinery, which should be added to the wear and tear schedule for computation of capital deductions. Most candidates gave incentives available in the VAT Act, yet the question was requesting for incentives provided for under the Income Tax Act. Question 2 of this paper, it was on employment and property income and required candidates to calculate the individual's net pay for the year ended 30th April 2023 and to advise on the criteria used to determine the residence of an individual under international tax laws in accordance with Article 4 of the OECD. Most candidates did not consider the fact that the individual's foreign employment income was exempt from tax in Uganda in accordance with Section 80 of the Income Tax Act. And most candidates did not take into account the tax credit for withholding tax paid on foreign-sourced property income. This is because the individual being a resident is taxed on income from all his geographical sources. But credit is offered for any tax he may have paid abroad as long as it does not exceed the tax that would have been paid in Uganda. Most candidates had a problem computing the net pay which is the take home. Most candidates deducted 5% contribution to NSSF and the contribution to the investment club from the chargeable income, yet these amounts are already included in the taxable income. They should be deducted after the tax has been computed. Also note that computation of 5% NSSF does not include benefits in kind, but only on cash benefits. Part B of the question was hardly attempted. Candidates are encouraged to revise the principles of international tax contained in the OECD model. Question 3 was on VAT, and it required candidates to assess whether a company can claim VAT on the construction of a warehouse and parking yard in the period between November 2022 and April 2023, and to advise the company on whether they should have taken on responsibility to follow up suppliers to declare VAT in their respective returns as a condition for them to claim input VAT. And to advise the company on the input VAT claimable at registration, given the transactions described in the question. And part B was to explain the conditions to be fulfilled by an international public organization so as to get an exemption for VAT in Uganda in accordance with the VAT Act. Whereas most of the candidates demonstrated an understanding of VAT registration process and requirements, they did not appreciate the rights of a taxpayer after registration. Taxpayers are allowed to claim input tax incurred on purchase of goods within 6 months prior to registration, provided the goods, both capital and inventory in trade, are still at hand at the date of registration. Those who were aware of the right to claim input tax prior to registration did not separate goods and services and ended up granting input tax even for services. The input tax that one can claim is for the goods that are on hand at the time of registration. Majority of the candidates failed to compute VAT claimable prior to registration from the set of transactions given in the scenario. Cement that was issued for construction of the parking yard was interpreted by many to be sales, and candidates ended up computing output tax and input tax on the purchases. This meant that most of the candidates changed the question and computed VAT payable instead of input tax claimable prior to registration. Students are encouraged to read and understand Section 28 of the VAT Act to appreciate more the input tax a taxpayer may be entitled to. Part B of the question seemed a gray area to the majority of candidates, as they were not aware of the first schedule of the VAT Act and the conditions outlined in Regulation 7 of the Value Added Tax Regulations. Many of the candidates made reference to the provisions of exemption as provided for in the Income Tax Act. Question 4 tested the oil and gas sector and required the candidates to calculate capital gains, tax payable on the disposal of a block, income tax payable on petroleum operations from a block for the year ended 30th April, and calculation of windfall tax, if any, arising from international oil prices, and tax treatment of the loss from another block. Most of the candidates who attempted this question had an understanding of how capital gains tax is computed on disposal of a block. And that's where most marks were earned for those who attempted the question. First of all, the question seems to have been attempted by very few candidates. The candidates were not aware of the windfall tax and could not even state and explain the formula and the components therein used in computation of the windfall tax. Whereas candidates were able to state that the loss made in a block can be carried forward, they did not mention that the loss in a given contract area is ring-fenced and can only be offset against profits from that particular area. Very few candidates attempted the number. Oil and gas is an area that students are encouraged to interest themselves in so as to understand the taxation of petroleum operations. Generally, now I'm going to general comments. Generally, candidates' work depicted a sign of inadequate preparation for the examination as observed from inadequate answers provided. Excuse me. Candidates should note that this examination tests one's ability to provide advice to a taxpayer. Mere calculations without explanations or advice are not sufficient for earning adequate marks. Citing the relevant provisions of the Act is much recommended at this stage. Many candidates demonstrated a fair understanding of the basic principles of income tax computation, but lacked knowledge where it required them to provide advice. A majority of the questions, probably over 60%, will be on income tax. This is because the syllabus is also heavily leaning on the income tax. So how do we prepare for these exams? First, obtain a copy of the domestic tax laws, the income tax, the VAT Act, and the Tax Procedure Code Act. Sorry, I did not put it in this slide, but you also get the Tax Procedures Code Act, the East African Community Customs Management Act. We also have the Excise Act, and make sure to read them. If you are attending lectures, do not assume that the notes provided by the lecturer are correct. You need to read these laws yourself and corroborate that what you have is actually the true information. Explore the URA portal for any guidance. The portal has been reorganized. Usually I would go to topics A to Z and I would find there a lot of information, but the portal now has been reorganized. You may have to go to the education section and look under each sector. They have organized them under each sector. Also, read decided court cases, because some items that are needed for adjusting the tax computation to arrive at the chargeable income may be picked from items which are not actually in the tax laws themselves, but which are as a result of decided court cases. Where you are undertaking self-study, ensure that the reading materials you are reading are up to date. The examiners will usually test amendments after a grace period of 6 months. Therefore, for the examinations in May 2023, the income tax amendment for the year 1st July 2023 to 30th June 2024 is eligible for testing, the grace period having ended in December 2023. However, for income tax, which is a historical, and the year can only be tested when the year has ended, if a question is on computation, in the May diet especially, you do not expect to be tested on the changes for the year 2023-2024. But for all other tax heads whose tax period is a month, then you expect that the questions are going to come from the amendments of 1st July 2023 to 30th June 2024, But for income tax, what will be applicable will be the year 1st July 2022 to 30th June 2023. Therefore, income tax, because of the nature of the taxation of income tax. Therefore, obtain a copy of the recommended reading material by ISPAU and practice the exercises. But as you practice the exercises, and even when you download past paper questions and solutions from the portal, be mindful of the changes in the law, because some practice questions and exercises may be based on the law as it was at the time. But every year there are changes. For instance, in the year 2023 to 2024, initial allowance has been repealed. You will find that none of the exercises in those reading materials are having exercises where initial allowance has been repealed. But as explained, for the May diet, because the year 30th June 2024 has not yet ended, you may not find a question which is requiring you to ignore initial allowance at this point. You also revise the reading material relevant for paper 11, especially if you are exempted. You need to know that information. Allocate sufficient time to revise. Now, thank you for listening to me.
Yes. Thank you very much,
Now we
Charity.
can go to questions. Yeah.
Thank you very much, Charity,
Yes, please.
for
I think
ably guiding the
I
students.
think I can stop. I
on how
can
to
stop
pass paper
sharing now.
17.
Yeah.
No, let the slides keep running.
I had
So
already
that's thinking
stopped.
we could refer to them. So we have we have a few questions, but according to me in your discussion, somehow you hinted on them. But let us go through them very fast because the next webinar is starting at 11. So just go through them very fast, and those that you've hinted on during the discussion, you can just, you could ignore them or you could just give them a fast response. Sorry, are you seeing the questions in the Q&A?
I'm seeing the question. I'm seeing a question from Geoffrey Chumbugwe, where he's saying, thanks CPA Charity. For what reason does ISPAU set numbers containing already repealed tax laws? I think I have already answered that. Income tax, a year can only be taxed when the year has ended. So much as I may have some provisions of the law repealed during the period July 2023 to June 2024, I am not able to set a year of income ending the year June 2024 when it has not reached. And therefore, the laws applicable for the year of income, we will test the provisions of the law that were applicable for the year of income for which the question has been set. I think I clarified on that one. In other words, for VAT and any other tax, nobody will set for you the items for the year of income which were repealed because the tax period is a calendar month, and therefore you can test those ones going forward. Kindly provide. I think I've mentioned this one also. Regan Kashaija, thank you, Charity, for your insightful presentation. Kindly provide more clarity on when new amendments should be effectively applied. I have talked about that one. We have a grace period of 6 months. Therefore, the amendments up to June 2024, the grace period ended in December and they are applicable now. But like I have explained, there is a unique situation with income tax in that one cannot tax a year of income which year has not yet ended. And therefore, it is not practical for anyone to set a question requiring you to compute chargeable income for a year ended June 2024 in May 2024. That's why it could be slightly different. Redgan Kashaija still is saying, I'm also inquiring whether computation of initial allowance on eligible property was scrapped off in the new tax amendments. Yes, it was scrapped off. The year ending June 2024. So for any examinations that you will be attending after June 2024, you may not expect to compute initial allowance. But for May 2024 examination, it may or it may not be. The examiner may decide not to tax additions to assets, and therefore you would not be required to do initial allowance. But if they test addition of fixed assets that required initial allowance, then you would be expected to compute it, because I don't expect the year of income to be after 30th June 2024 when we have not yet reached it. Then the other one from Rachel Ashabahebwa. Rachel Ashabahebwa is like, some solutions provided by ISPAO aren't correct. So how can students be sure that the students who fail do so not because of the wrong marking guide? My advice is, whenever you download a guide from the portal and you feel there is something that is not correct in that portal, please notify the institute, because you may think it is not correct when that is what the examiner intended. But if you feel that there is something not correct in the marking guide, please notify the institute immediately for corrective measures to be taken, because you may think that it is not correct when it was the intention of the examiner, and an explanation will be provided. I see something from an anonymous attendee. So we will not be examined in initial allowance this May, June. Like I have explained, and I will keep explaining, please take note of the year of income that is being examined. If the year of income that is being examined is year ended 31st December 2023 or 30th June 2022, or for that matter, 30th April 2024, please note that the amendment for the year commencing 1st July 2023 to 30th June 2024 cannot be applied to that question. You would have to apply the act that was in effect during that year. That is all that I can say. And then I see someone here saying, does the initial allowance explanation you've been given apply to taxation paper 11 too? As long as we are talking about a year of income, even in paper 11, it should apply. I do not see any other question. Oh, okay, I see one down. Does the group limit in section 25 of Income Tax Act apply to interest on a loan paid by a group member who got a loan from an independent third party who is not a group member? I think let me read the section in order to be clear what I'm going to tell you. I don't think it is from a group member. I think it's for a loan wherever obtained. Section 25(3) reads, the amount of deductible interest in respect of all debts owed by a taxpayer who is a member of a group other than a financial institution, microfinance deposit-taking institution, Tier 4 microfinance institution, or person carrying on insurance business shall not exceed 30% of the tax earnings before interest, tax depreciation, and amortization. You will note that whereas the original thin capitalization regulation referred to loans from group members, the provision in section 25 does not discriminate. So even if the loan is from a third party, I guess it would apply. Now this one, I don't know whether I'm the one. Okay, I think is meaning IFRS. Is IFRS well explained in the latest ISPAO and URA website? For IFRS, you go to URA, please, not ISPAO website. And I think there is enough guidance on the URA website regarding IFRS application. Clear?
Yes, Charity.
I don't see any other questions.
Yes, maybe we end it here. Unless there's something you wanted to say in conclusion.
In conclusion, I'd just like to advise members to read and revise. There is no shortcut. That's all I can say.
Okay. Thank you very much, Charity, for ably explaining to students what they have to do in order to pass CPA paper 17 for the coming sittings. We are very grateful. And I would like to hand over the platform to Esther, our coordinator.
Thank you so much, CPA Claire, moderating the session. Thank you so much, our presenter. We're really grateful for the work done, and always thank you so much for supporting the profession. So our next webinar is at 11, and that is CPA 9. Thank you so much. Have a nice day.
Thanks.